Actually, drag and mouse bring it to the screen. Scrolling around. That's it.
Yeah. So, a very good afternoon, everyone. So, in the last class, we have discussed the introduction to financial management. So, we discussed what is financial management. Financial management means managing money. What does manager do? Manager makes decisions. What decision manager makes? They make decision regarding investment decision, financing decision, dividend decision. We also discussed what are all the decisions. Decisions can be short term, decisions can be long term. So the today's discussion is about investing decision. Coming into the topic, investing decisions, we all know that investment can be short term and long term. So if you are making a short term investment decision, which means it is a working capital decision, I'll just tell you for any business. So I hope you all would have studied accounts. So we have a balance sheet, liabilities and assets. So for example, we are just starting a business. So we have building, okay, we'll need building, we'll need machinery, we'll need land, okay, we'll need other assets, okay. So say this is a business. Say we need assets worth 1,000 crores. So how will get those 1,000 crores? You'll print money? No. Beg, borrow.
Own money or what?
Okay. So either you will have your own money or you borrow money. Say you're taking some debt. Okay. You're taking debt of 1,000 crore rupees. Okay. You took debt of 1,000 crore rupees. You're invested in building, machinery, land, other asset, everything you kept ready. Now business started, right? You have land, building, machinery, land. We'll just see. Business will start. No. You have to use that asset, right? To generate income. So only to using the asset, you need to have employees. You need to have some working capital, right? So only after investing in working capital, you'll be able to use those assets and then you'll be able to generate some income. Okay, working capital means any capital which is required for day-to-day activities of business. So this is called long-term capital. Long-term capital can be invested for buildings, machinery, land, other assets. For this, you will generate in return over the period of years. So, working capital means any capital which you are investing for day-to-day activity. See, any business, first you will make an expense only, then you will earn income, right? You will not earn income from first day. First you will make expense, you will employ you will hire employees, you will pay salary to that employees, and after that you will earn some money. So only having assets is not important. So under investing decision, we are going to discuss a chapter which is called capital budgeting decision. We all know, see, whenever you're sitting in a financial management class, think yourself as a financial manager. Think yourself as a finance manager. Think yourself that you are the CFO of the business. Only then you will be able to appreciate the subject. So just imagine you're the CFO of a company. You are responsible for making decisions. Now, there is something called as capital budgeting decisions. You all know what is capital. Capital can be long term or short term. You all know short term capital means working capital. Long term capital means you're investing that capital to purchase some assets. So, investment can be two types. So, any long term investment decision is called capital budgeting decisions. Okay, first I'll just give you an overview what is it that we are going to study in this subject. You will not understand first, but just I'm giving you an overview what and all are the things that we are going to study in this subject, and then we will get into a deep dive of this subject. Okay. So the first thing that we study is AR, which is accounting rate of return. Okay, don't worry if you're not able to understand. Once I'll build all the concepts, you will be very comfortable in understanding and you will be also comfortable in doing the problems. So accounting rate of return. This is just an overview, which is what is the objective of this chapter. Another thing would be payback period, discounted payback. From exam point of view, this chapter is very important and this is also a very interesting chapter. So discounted payback period. Then we have NPV, which is net present value. We have IRR, internal rate of return. We have PI, which is profitability index. It is also called as benefit or cost ratio. Then you will also study about conflict between decisions. And then you will study something about MNPV, which is modified net present value, or MIRR, which is modified internal rate of return. So once this chapter is completed, you will be able to have an understanding of all these concepts. And mostly from exam point of view, problems come from NPV, IRR, and conflict between decisions. So mostly from exam point of view, these three are the concepts which are important. Now let us understand. Fine. So now let us understand why we are making any decisions. So whenever you are making any capital budgeting decision, what is the importance for business? See, once you are the CFO of the company, the company is not paying you salary just to do the work. Okay, they are paying you salary to make decisions, and not everyone can make decisions. As we have already discussed, decision involves lot of thinking. It involves, lot of things that you have, lot of factors that should be considered when taking decisions. You will get lot of data. You have to identify which is relevant data, which is irrelevant data, and then you are able to. In last class, we also discussed about time value of money. Time value of money is one important concept that is used in capital budgeting decision. So let's understand why capital budgeting is important. So I'll tell you first thing, it is a long-term investment decision. Whenever you are investing in any machinery, you are investing 1 crore rupees in any machinery, it is a long-term investment decision. So which means it involves a huge amount of risk. It involves huge amount of commitment. It can also affect the solvency of any company. Say if you're making some wrong decision and if you're not able to generate cash flows, which means that your company your company goes for a toss. So why capital budgeting is important? Before taking any decision, you should first identify whether any project is feasible or not. See, what is business? Business is a portfolio of projects. It has many projects into it. So one such project can be, if for example, I'm just taking Reliance Industries. So Reliance Industries is one company. It is also into textile. It is also into textile. It is also into FMCG. It is also into petroleum, and it is venturing into new businesses. Which means you have to see every business as one vertical and every business as one project. So once you take that, And whenever any investment, for example, let's say that they want to invest in another industry, say now Reliance wants to come into the car industry, so say that investment decision, once they are making a decision, they have to invest 1,000 crores. So that is a very long term investment decision, and if they are failing, so the company's profit gets affected. So the second one is, it is important because it has huge initial capital outflow. I know the first class feels theoretical, but it is important for concept building. The third one is, the decision that you take is irreversible. Once you take a decision, there is no going back. A decision took is took. Because if you want to come out of that decision, there are huge costs involved. For example, you're invested in some factory, and tomorrow if the factory is not working properly, you cannot just shut down the factory, because still you have to pay salary to your employees. And even if you're selling that land or building, you'll be able to sell only at a very half price of cost. Fourth one, it is very risky. Okay. Fifth one, as I discussed, closure involves huge cost. Any decision that we have to take, we have to understand certain factors. So these are the factors that you should consider before taking any capital budgeting decision. You see this as the marriage decision. Okay? Say you're going to marry someone. It is a long-term decision. It is not a short-term temporary. Okay. I know all these short-term casual dating, all these things we are adopting from Western culture, but we'll talk about proper Indian marriages. It is a long-term decision that you have to take. Second, huge capital outflow is that, okay, once you get married, you have to call hundreds of guests, thousands of guests. You have to keep marriage in a very big reception, and you're going to spend a lot of money. See, when you're dating, you don't have to spend money, but when you're going to marry, which means you're giving a commitment. So you just have to announce to the world that, hey, I'm getting married. So that involves huge capital outflow. It is an irreversible decision. Okay. So once you marry someone, afterwards, if you don't like it, you cannot just leave it, right? Hey, it's a bad decision. You cannot do that. It is irreversible. Once a decision taken is taken. Okay, donkey or monkey, now you have to be it forever. Right? It is risky decision. Of course. We don't know what comes, right? Uh, they say appearances are deceptive. So once you go, once you see the girl, you just see her and smile and you say, okay, I want that girl. But once you get married, the true colors will come out. But so that is the risk which is involved, right? And of course, closure involves huge cost. Even though you both come into a situation that no, now it's not going to work out, you'll go for divorce, but it also includes huge cost. I'm not talking about monetary cost here, but psychological cost, society, everything. We just think it before making any decision. You have to understand there are certain factors that we have to take care of, and because of which that decision is very important. So before making any capital budgeting decision, these are the factors because of which capital budgeting decision is very important. It includes long-term investment. It has huge initial capital outflow. If anything goes wrong, which means all the CEOs and shareholders will just pull your corners. Like, what have you done? Like, because of you, we have lost such and such crores of rupees. And always think in crores. Okay, don't think in thousands and lakhs. We are chartered accountants. So once we become the CEO of the company, we'll talk only crores. Okay. That's the reason I'm taking example only in crores, so that you have that high vision. For you, crores should be like thousands. So I hope you understand why capital budgeting is important, right? It has long-term investment approach. It has huge capital outflow. It is risky. Why it is risky? Because cash flow you're going to make today. In the zeroth year, you're making a cash flow. But inflows you're going to receive only in future. And of course, future is uncertain. Anything can happen. Okay. Say that we cannot predict, right? Say this is Shankar Academy. Now we are just budgeting, okay, like we want to open 5 new branches in Chennai. Okay. This is not standard costing. In standard costing, we budget only for 1 year, right? In capital budgeting, we budget for 5 years, 10 years, 15 years, 20 years. So when we budget for 5 years, 10 years, 15 years, it is a very risky decision. We don't know what will happen. We don't know whether the faculties today will be famous after 5 years or not. We don't know whether CA Institute is there or not. I'm not talking CA Institute will be closed, okay? Maybe it will get merged with some other institute, okay? We don't know what will be the demand of chartered accountants in future, okay? We don't know the future. So it is a risky decision and a lot of factors they have to consider before taking any capital budgeting decision. The entire capital budgeting decision you're going to do as a finance manager or as a CFO. This is one core subject, and once you get hold of this subject, not even finance decision, you can even take life decisions. Okay. Now let's come. You have understood why a capital budgeting decision is important in business terms. Now let us understand what are all the decisions. Okay, what are the types of decisions that you are going to make in business? Now, what are the types of decisions? I'm slowly going into problems also. Okay, what are the types of decisions that you're going to make? Whenever in capital budgeting, you'll always get some proposals. Okay, say you're the CFO of the company. Okay, now the CEO comes to you and say that, hey Thofik, like we got some two proposals, not marriage proposals, business proposals I'm talking. Okay, say one is a proposal to open a oil factory in so and so city. Another one is a proposal to open some FMCG industry. Okay, now they got two proposals. One is to invest in an oil factory. Another one is to invest in some FMCG business. Okay, we'll just call it as project A and project B. Okay, and you're the CFO of the company. What are the types of decisions that you're going to make in capital budgeting decision? First one is accept or reject. Okay, this is one type of decision. They'll just tell and say that, hey, we have two projects. You can either invest in project A or project B. So which means either you have to accept project A or you have to accept project B. Okay, if you're accepting project A, which means you're automatically rejecting project B. Okay, for now just forget project B. Say you just got a proposal for project A, say the oil company. Your initial outflow is 10 crore rupees. Okay, and in year 1, 2, and 3, you are receiving 3 crore, 3 crore, and 3 crore. Okay, for now, just forget time value of money. Okay, just for the ease of understanding. So, what is the net cash inflow? Negative 1 crore. Whether you'll accept this decision or not, you'll reject this decision, right? So, this is one type of decision that you're going to make. I'm just making it more simple, but once you make actual decision, there are a lot of factors to be considered. Time value of money should also be considered, and you will get mutually exclusive thing. And the second decision is mutually exclusive decision. This is either or decision. Either you have to select project A or you have to select project B. Once you're selecting project A, which means you're rejecting project B automatically. Once you're selecting project B, which means you're rejecting project A automatically. Now say here also the initial outflow is 10 crore, but here the inflow is 4 crore, 4 crore, 4 crore. What is the net cash? 2 crores positive. Now whether you're going to accept or reject, you're going to accept. For example, you got these both proposals and someone asked you, you can invest only in one. Which project you will select? You will select the second project. Why? Because comparing to project A, project B is more attractive, right? So this is mutually exclusive decision because you have only 10 crore rupees. Now you can do only one project acceptance or one project rejection. So which is mutually exclusive decision.
बेसिकली मुझे बात करें तो वहाँ पे मूव हुआ है
हाँ move on.
नीचे और
Yeah. Fine. The third decision, it is called capital. See, I understand. Always, whenever we are starting any new chapter, first one class or first two class will always be theory. It will be little boring, okay? But understand that this is helpful for concept building. Once you build your concept and once we enter into problems, solving problems will be a cakewalk. Because, as Steve Jobs said, trust the process. Okay. Once you trust the process, you will get your desired results. So at this point in time, you have to trust your teacher. So third one is capital rational decision. I'm actually giving you lot of finance jargons because these are the words which is used in your textbooks. So capital rational decision is also a accept reject decision, but here you have a capital restriction, which means the CEO comes and tell you like, hey Thofik, I have 100 crore rupees and I have these 20 proposals. Okay, some proposal is of 50 crore, some proposal is of 10 crore, some proposal is for 5 crore. Okay, cumulatively you have proposals worth 200 crores, but you cannot select all 200 crores proposals or you cannot reject all 200 crore proposals, right? So here you have to pick and choose. It is a capital rational decision because either you will select 1, 2 or 3 or you will select project 3, 4, 5 or you will select 1, 5, 8. So there again you have to make some decision. So that is called capital rational decision. If you have some money, you have to allocate that money, where you have to spend that money, right? So it is a capital rationing decision. Any capital budgeting decision is always forward looking. What you will do in this chapter, in very few words, is that the CEO of the company, okay, I say problem, you just imagine as a case study. You are the CFO of the company. Now, yes, open the question paper, there is a half page problem. So that half page problem is a proposal that CEO is giving to you. Now you have to read the question. Okay. Always in financial management, more than answer, understanding the question is important. And once you understand the question, once you understand the proposal, you have to make decision. What are those decisions? What are those three decisions? Come on.
uh, capital rational decision
Capital rational decision,
accept
accept reject decision, mutually exclusive
Mutually
decision. Okay. In accept reject, you will get one project, and based on that one project cash flow, you have to evaluate whether you have to accept that project or you have to reject that project.
right
Okay. In second decision, you will have two projects. Okay. And both are mutually exclusive, which means if you are selecting project A, project B is automatically getting rejected. If you are selecting project B, project A automatically gets rejected. So this is mutually exclusive decisions. Now talking about capital rational decisions, it is also accept and reject decision, but there is a capital constraint, which means you only have some amount of money, some amount of proposal, and you have to allocate that amount of capital to that amount of projects. Okay. So you have multiple proposals with a capital budget. And you have to allocate that budget based on the returns. Always a decision is made based on some standard. Okay. You know that return is calculated or it is expressed as percentage. Okay. Whenever you are making any decision, you always keep a standard in your mind, right? For example, you're just going and searching for a girl or you're searching for a boy. You have some set standard in your mind, right? I want a girl like Katrina Kaif. Or okay, either visualization. Imagining is not bad, right? But you have some certain set of standard. If any girl is less than Katrina Kaif, you'll automatically reject her. So there is always a standard which is set. So here also, in making capital budgeting decision, you will have some expected rate of return that you are expecting. It can be risk-free rate of return, or it can be risk-free rate plus risk premium of that project. Okay. Now you'll understand what is risk-free, what is risk-free premium. Everything I'll cover it. But what you have to understand right now is expected rate of return. You're following up?
Yeah.
Okay. Expected rate of return. It is a standard return that a company wants. Coming to the example, project A CEO is coming to you. He's proposing to you, like I have one project A. Project A is giving 12% return. Whether you'll accept or reject.
Yes.
Yeah, so you have to ask the CEO, hey, okay, I understand. Okay, project A gives me 12% return. But what is our expected rate of return? So the CEO said, like, minimum I want 15% return. The CEO said, like, so now the expected rate of return is 15%. Now you accept the project and reject the project. Reject the project. Why you reject the project? Because it is below the expected rate of return. So while making any decision, you have to see a standard return. If the project return is more than the expected return, you will, if the project return is more than the expected return, you will accept the proposal. If the, okay, if the expected return is more than the project return, you will, but you're sleeping. Huh? Read again. If the expected return is more than project return,
If they expected it, you will reject it.
what is your expected return?
The return is 12.
15%.
My project return is 12.
12%. You'll accept
Only
or
give me
reject?
12%. That is 15. So I reject.
Okay. I was just checking whether you are aware of it. Okay. So you will reject it. Wait, I think there is a mistake. I think there is a mistake. Say the project return is 15% and the expected return is 12%. Actually, I am sleeping. Wait. What is the project return?
Project returns, the return is going to come from the project.
Okay, what is expected return?
What I'm expecting.
What you're expecting? You're expecting 12%, but you're getting a project return of 15%. You will accept. Okay. The second one, you're expecting 15%, but you're getting a project return of 12%. What you do? You will reject. Okay. No one is sleeping. You understood this concept now? Fine.
What if it is equal? Should we accept or reject?
Okay. It's a very good question. Say you have a project return of 15% and you also have an expected return of 15%, which means it is indifferent. Okay. Either you accept or reject, there is no, there is no monitoring. But usually, see, as per textbook, you just have to say it is an indifferent decision whether you accept or reject. Okay. But practically, they don't accept. Talking about practicality, if they're expecting 15% and if the project return is also 15%, they are going to invest, they're going to, put all the efforts. And then, see, as I said, if the expected return also covers the risk premium, they can again take the risk. But it is the risk-free return, they can directly put it into the FD, right? Fine. Any other questions, Rahul? No. Fine. Again, you are the CFO of the company. Okay, this will go on from end. Okay, from class 1 till the last class, you just have to imagine you are the CFO of the company. Only if you imagine, you will feel like you are the big shot. You will feel like, okay, like I'm doing something great. Only then you will understand the intensity of making decisions. Just don't make decision for the sake of, just for the sake of answering the question. You always visualize that you're actually getting something. If you're just writing 1,000 crores in paper, you will feel like, what is this? But if you're actually making decision of 1,000 crores, you will sweat. Actually, if you're making some big decisions, you will sweat. Right? Uh, Fine. Before making a decision, we'll ask some data, right? Say the CEO is coming and telling you like, hey, I have a proposal for project A. We'll ask some data, and the CEO is telling you, okay, I'm just telling you, the CEO is coming that, hey Thofik, you're the CEO of the company. No, actually we got a proposal for project A. I have to take a decision whether I have to accept or reject. Okay. So what the CEO does, he take a coin, he just toss it, head na reject, tails, like head na accept, tails na reject. He got tails and he rejected. Good or bad? Bad. Foolishness, huh? Right. You cannot take decisions by chance, right? CEO it is good or bad? It is bad. Fine. But not everybody is Rajinikanth, right? To take decisions by chance. So whenever you make any decision, you have to make a calculated decision. Now to have calculation, you need data. Like if you're asking what is our expected rate of return, that is one data that you're asking from the CEO. So now we'll understand what are the data which is relevant for capital budgeting decision. Fine. So let's just take a small revision. What is capital budgeting? It is an investment decision. Why capital budget is important? It is important because
It's a risky project.
it's a risky
Yeah, it's
project.
an investment.
You have huge investment. An investment is made today, returns will come tomorrow. There is always uncertainty involved. It is risky,
First, what if you choose to be a
right? And even if you, it is irreversible decision at first place. And even if you want to close it, huge costs are involved. So that's the reason before making any capital budgeting decision, you have to, before making any capital budgeting decision, you have to evaluate. You have to make decision.
check?
How you will evaluate? You will evaluate by having a standard. And once the project return is more than the standard return, okay, in simple terms, if the project return is more than your expected return, you will accept. If the project return is less than your expected return, you will reject. Fine. What are all the types of decision that you will make? It is accept, reject, mutually exclusive decisions, or capital rational decisions. Fine. Now let's go. What are all the data that you'll ask the CEO of the company to make any decision? First one is consider cash flow and not accounting profit. Even in the last class, I said you that in finance books, accounting profit makes no sense. Fine. So a finance manager don't even look at the balance sheet, the P&L. He will just throw it into the dustbin. What he wants is the cash flow. No, why he want cash flow? Why cash flow is revenue? Why not accounting profit?
free position to pass your entries like depreciation.
Okay, because you have approval entries, you have depreciation. Okay. Now I'll just give you an example. Say my accounting profit, I'm using SLM method. You are using WDB method. Same business, same project, everything is same. But my profit is different, your profit is different. Why? Because of accounting policies, because of assumptions. So accounting profit is always ambiguous, but cash is not ambiguous. Right? You understood why in finance we are taking cash and why we are not taking accounting profit? Because accounting profit is subject to assumptions, subject to policies. Company policies is also involved to take. The second thing, see, I'm going into the bank. Okay, I'm showing my PL. Hey, like my PNL, the profit shows 1 lakh, 1 crore rupees. Okay, my profit is 1 crore rupees. Give me interest on 1 crore rupees. Give up.
Profit is 1 interest.
He will give interest, right? No, because you're giving paper, right? You're going to the bank, you're just submitting the PNL, you're telling that, hey, this is my business, my profit is 1 crore rupees, give me interest on 1 crore rupees, he will give out. No, why? Because the profit is in paper. See, you're making a sale of 1 lakh rupees, okay? You're purchasing 80,000 rupees, you're making a sale of 1 lakh rupees. What is the profit?
Chasing is 80,000, sale is 1 lakh 20,000.
20,000 is the profit. Say, the sale is not cash sale, it is credit sale. What is the profit? It is 20,000 rupees profit. Okay. Now, this year, you're going to the bank and you're telling that this year I have made 20,000 rupees profit. Next year, you have made credit sales, right? All the person who bought from you became bad debts. Swaha. What is the profit?
Negative.
Negative 20,000. Huh? Negative 1 lakh. Huh? Negative 1 lakh. Huh?
You made a sale of 1 lakh, everyone is not paid.
Who will pay to the suppliers?
Supplies already made last year.
Right. So actually, you're making a loss of 1 lakh rupees the next year, 20,000 profit first year. So what is the net profit? Negative 80,000. Huh? What is the negative 80,000? You have to pay back to your suppliers, right? Now all the suppliers are coming to your home. Hey, give me the money. What will you do? No, I sold it for 1 lakh rupees. That person just ran away. I'm putting a case on him. I'm not recovering money. It became swaha. Now, what you'll do? Nothing, right? So that is the reason we don't take accounting profit. This year you're telling I'm profit making. Next year you're telling you're loss. Who will believe you? No one will believe you. So accounting profit are subject to assumptions, policies, everything. And on profit you will not receive interest. On cash you will receive interest, right? As I said, if you are having 1 lakh rupees profit, you are submitting the PNL to the bank. To the bank. Will he give interest on 1 lakh? What he will say? Give me 1 lakh cash, he will give interest, right? So you cannot compound or discount profit, right? I've taught you discounting in the last class, right? Time value of money, understood? So you cannot do compounding or discounting of profit, but you can do discounting of cash. So whenever you're making any decision, there is a time gap involved. Wherever there is time gap, you always have to consider time value of money. What is time value of money? The discounted cash flow. But you cannot discount accounting profit, you can only discount cash. I'm just telling you the importance of cash flow over accounting profit. Fine. So to consider time value of money, we have to take this decision. This is one data. You always have to ask, whenever you tell, okay, give me some data, he will give you PNL, what you will do? Throw it into the dustbin. What you will do? Throw it into the dustbin. And then you will ask, give me the cash flow. Okay. Now there are ways to arrive at the cash flow from net profit. You will study cash flow statement, or you will even study now. Okay, in accounting you would have read something called as cash flow statement. So what you will do from net profit, you will arrive at the cash, right? So the same thing you do here also. You only have to consider the cash flow and then you have to take decision. You have to discount those cash flows, and then you have to find the net present value, and then you have to take decisions. What is net present value? We'll come back. Okay. Second one. Why cash is important? Because any initial outlay that you're making in cash. Right? Suppose you're investing, I'm telling, suppose there is a project worth 1,000 crores. You're investing that 1 crore in cash, and first year zero. You're purchasing machinery, you're purchasing land, you're purchasing building, everything you're purchasing. What do you do? You're investing that money, you're investing in cash, right? So now you're getting return. That return should also be in cash, right? If I'm telling you, okay, I'm investing 1,000 rupees, but I'm getting a profit of 5 crore in first year, 10 crore in second year, 20 crore in third year, what do you do? I don't want accounting profit. I want what is the cash flow in first year. Say the cash flow in first year is 20 crore, the cash flow in second year is 10 crore, the cash flow in third year is 3 crore. I am more concerned about the cash flow. I don't want any accounting profit. Whenever I see accounting profit, I will make certain adjustment and I will convert it into cash flow. So this is one more reason why cash flow is important. Why cash flow is important? Because if you're making initial outflow in cash, you also have to compare the returns also in cash. If you're comparing it in profit, okay, you cannot compare a donkey with monkey, right? You cannot add donkey plus monkey. Donkey is added by donkey, monkey is added only with monkeys. Okay. So first data is cash, right? So you are the CEO of the company. CEO comes and tell you that, hey Thofik, I want to make some decisions. There is one project called Project A. So whether to accept or reject, what you will do? Take coin. We are not Rajnikant, okay? What you will do? Ask for cash flows. Second thing, he will give you the cash flow, but we have to consider only incremental cash flow. Now, this is very important. Okay, many people don't understand this, and this is even there in final. One thing is you don't have to consider all the cash flows. You only have to consider incremental cash flow. Incremental cash flow is also called relevant cash flow. Okay, I'll give you an example. What is incremental cash flow? Okay, so say there is one project. It is making a sale of 1 lakh rupees. Okay, you have sales of 1 lakh rupees, for which you need material of say 80,000 rupees. Then you have to pay salary and also. Okay, say Rahul is the only employee, so we have to pay labor. Actually, for chartered accountants, labor is not a good word, right? I know you did all this in articulation, but okay, we'll use salary. You're paying salary of 40,000 rupees for this project. What is the net? What is the cash flow? Net cash flow? All these are in cash. Okay, say the sales is in cash, you're paying in material is cash, you're paying salary in cash. Okay, it's cash flow, profit, whatever you say. In this example, it is cash flow minus 20,000. We'll accept this decision or reject this decision. We'll reject the decision by it is negative cash flow. Right? Now, say I'm giving you one more information. Say this person, okay, this person is Rahul. He was actually working in some other project, but he was not working anything. He just comes to office and he sleeps. So he is an idle labor. Okay, he don't work anything. He come to office, he sleep. We are actually paying him salary for doing no work. Now I got this project. Now I'm deploying Rahul into this project, and he is an idle worker. Okay, he is a idle person. Now, if you're accepting this project, whether you'll make this sales, whether you'll receive this cash flow, yes or no, say you're accepting this project, which means you will receive this cash flow, yes or no? You will receive this cash flow. If you're making sale, you will have to take materials. So this outflow is certain or not, you make this certain a cash flow. Okay. Now you are accepting whether you have to pay salary or not. You're accepting this project, you have to pay salary. Now you're rejecting this project. Whether you will have this inflow or not, the sales inflow, no, you will not have this inflow. You're rejecting this project. Whether you'll purchase any material, no. You're rejecting this project. Whether you'll pay salary to Roberts, yes. Which means any cash flow which is relevant for making a decision is an incremental cash flow. If you're accepting a project, you will make this cash flow. You will make this cash flow. But this is irrelevant of whether you're making this decision or not. You are always going to spend 40,000 on that. So you don't have to consider irrelevant cash flows. Are you getting it? It is a very important concept. Okay, I'm just telling you with this example, but when this comes into the problem, many people ignore this. You have to see. First, you have to ask. I'm making a flow. Okay, first you have to ask the cash flow. Then you have to identify whether it is a relevant cash flow, whether it is irrelevant cash flow, which means incremental amount. What is relevant cash flow? Which does not, which affect the decision. Now, for example, this cash flow, it does not affect our decision. Whether I'm accepting the project or whether I'm rejecting this project, I am definitely going to pay 40,000. Right? Are you all following this? Now, I'm giving you one more example. He was doing no work here. I was paying him 40,000 salary. Now I'm calling out here, come here. I'm going to deploy you in this project. Rahul is telling me, "Ayyo, work panaduma. I want 50,000." Okay. You say like, what? Like, we are paying 40,000. Okay. The Rahul negotiated, and he said, "I need 50,000. Only then I will work." Now the management agreed. Okay, I'll pay 50,000 to them. Okay. Now here it is 50,000 rupees. Okay, it is not 40,000 rupees. If you're going to deploy Rahul in this project, it is 50,000 rupees. Now just tell me, you're rejecting this project. Whether you're going to make this, no. You're rejecting this project. Whether you're going to make this 80,000, no. You're rejecting this project. How much salary will pay to Rahul? 40,000. Now you're accepting. What is the cash flow from say 1 lakh? You're accepting what is the cash flow from material? Minus 80,000. You're accepting what is the cash flow to Rahul? Huh? You pay 50,000. What is the incremental cash flow? 10,000. Okay. The incremental cash flow is cash outflow is 10,000. Now, whether this 10,000 is becoming relevant for this decision or not, it is becoming relevant for this decision. Okay. Now you're understanding how important is relevant cash flow because it is affecting. Now, if you're not considering whether it is idle or not, you will end up rejecting this cash flow. Rahul will just sleep in the office. Okay. Now you're bringing Rahul into here. Okay, say his salary is 50,000 rupees. It is 1 lakh rupees less 80,000 rupees less 10,000 rupees. Now, what is the net cash inflow for the company? 10,000 plus. Now you will accept the reject. You will accept. So you understood the importance of how incremental cash flow is very important. Okay, come from zero. You are the CFO of the company. CEO comes and tell you, Thofik, I have project A. Whether I should accept or reject, what you will do? You will ask for data. What is the first data you will ask? Cash flow. What cash flow you will ask? Incremental cash flow. Are you following from till here? Interesting? Till here? Fine. Let's come to the third part. Okay. So in your business, say you have three partners. Okay, you have three partners in your business, and you are earning some profit of say 1,20,000 rupees. Okay, you are earning a profit of 1,20,000 rupees. What is the share of profit to each partner? 40. Three partners. Three partners are there. Okay, three partners are there. Okay, three partners are there. Okay, say one partner is Thofik, Another partner is Rahul. Third, who is a friend? Tell your friend. Tell him your name.
Ganesh.
Ganesh. Okay. Ganesh. Now, what is the share of profit to each person? 40,000 each. Okay. You forgot one thing here. There is also one more partner here, which is government. Yeah. You will ask 25%. How many partners are there? 4 partners. Now, how much you'll pay to each?
75.
Okay. Now you understood. You thought we are 3 partners. Okay. You worked hard. You earned a profit of 1,20,000 rupees. At the end of the year, your 4th partner will come to you. Man, 25%. Give it to me. What is that?
Tax.
Tax. Fine. So, don't forget tax. Because cash flow will have impact on taxation. I mean, taxation will have impact on cash flow. Anyway, both are right. Okay. Thofik, Rahul, Ganesh, working very hard. Government, what is it doing? Asking for tax. Whether we have to pay tax or not. Why we have to pay tax? Government is not doing anything. Okay. He's just a sleeping partner. Why you want to pay 25% to government? Because
Giving us infra facility.
they are giving you infra facilities. Giving up. Okay. Fine. Whether they are giving or not, it is irrelevant decision for us. We have to pay 25% at any cost. So, actually, we were in the third data. Okay, third thing we have to always ask for taxation impact. Okay, which means cash flow should be considered after tax. Okay, you have to always consider cash flow after tax. Say you have a project. Okay, here an amount. Year 0, you are having an initial cash outlay of 10 crore rupees. 1, 2, and 3. Okay, say 40 crore, 40 crore, 40 crore. Actually, we also have to consider time value of money, but just for ease of understanding and for understanding of this concept, we are ignoring time value of money. But while doing drop terms, we have to find the discounted cash flow, only then we have to come back. Okay, just ignore. There is no time value of money. Accept this project and reject this project. Accept this project. Okay, but the government is coming and telling you that, say the taxation is 50%. Okay, 50% tax. Now you have to actually find the cash flow after tax. Okay. So what is the after tax cash flow? 40 crore, 20 crore, 20 crore, 20 crore. You'll accept or reject? So taxation also becomes an important part by taking a capital budgeting decision. Following? Interesting? Whenever you're making any decision, because tax is a real outcome. Say your company is in loss, okay, you have some carry forward losses. This is just an very advanced, there is no problem, but just to have your curiosity, I'm just asking you. You're actually not making any, okay, cash flow is positive, but accounting profit is negative. Possible or not possible? Possible. How it is possible? And maybe depreciation, okay, but there is no depreciation here. Say your depreciation cost is too high, which means your accounting profit is becoming negative. Okay, but actually your cash flow is positive. Now you will have this taxation impact on it. Think it.
Accounting profit is negative.
Okay, accounting profit is negative. Okay, but actually your cash flow is positive.
Yeah.
Say your accounting profit is negative 5 crore rupees, but you're actually having a cash inflow of 10 crore rupees in your financial books. First answer whether it is possible or not possible. It is possible. Now, if it is possible, I have said to you that taxation is also an important part that you have to, inculcate in your decision. Now, whether you will do, say the tax rate is 50%, whether you will deduct 50% from the cash inflow.
It's in loss 5 months.
It's in loss. We said that accounting profit is not relevant.
Tax paid on
Yeah, tax is paid on
accounts.
accounting profit. Tax is not paid on cash. So, whenever a tax is actually paid, you have to consider it in the decision. Say you are a loss-making company, you have some very much, okay, in DT classes you would have learned, whenever you have any losses, you can carry forward those losses for the next 8 years. Say you have some huge accumulated losses, you're carrying forwarding it till 8 years. So there is no cash outflow, which means you will not consider taxation. You will not consider taxation impact here. This is actually finance level, but I just wanted to check whether this question is coming in later. Right? According to finance books, depreciation is the depreciation is a cash flow or not a cash flow?
Not that.
It's
Not that.
it is not a cash flow. Which means you have to consider depreciation or not. You have to consider depreciation. Okay? Now let me give you an example. Say you have a sales of 1 lakh rupees. Okay. You have a okay. Let's not go into sales. Directly we come into profit. Okay. This is profit before taxes and before depreciation also. Okay. Before depreciation, you have two projects. Okay. 1 lakh rupees. This is also having profit of 1 lakh rupees. This is also having a profit of 1 lakh rupees. Okay. Now, as per accounting books, you have depreciation. Okay. Here the depreciation is 30,000 rupees. Here the depreciation is 20,000 rupees. Possible or not possible? Say this is using SRM method, that is using WDV method. Possible or not possible? Possible. Correct? Huh? Now, so you will get profit before tax. What is profit before tax here? 70,000 rupees. What is profit before tax here? 80,000 rupees. Okay. Say tax is 50 percentage. He will pay tax on 50%, right? So what is the tax here? 35,000. What is the tax here? 40,000. Actually, I'm very happy that you're not using calculator. So profit after tax. What is 70 minus 35? 35,000. What is 80 minus 40,000? 40,000. Correct? Huh? Which project will accept?
Those are not given.
Cash flows are not given. Correct? Huh? So to find out the cash flow, what you have to do? Because depreciation is not at all a cash. Okay, this profit, okay, say this is actually cash profit only. Okay, so you are getting actually a cash gift of 1 lakh rupees, and you are having depreciation of 30,000 rupees. But what is depreciation? Depreciation is just amortization of your asset over the life of this. Correct? Huh? So now this depreciation is not considered for financial profit. So to find the cash flow, what you will do? Add back depreciation. What is the depreciation amount here? 30,000. What is the depreciation amount here? 30,000. Now, what is the cash flow? 65,000. 60,000. Which is? First one. Why? Because the cash flow is more here. Understood? If you are actually taking the profit after tax, you will consider this. But when you see the cash flow, you have to consider this. Which means accounting profit sometimes can lead to it can lead to wrong decisions. Always have to take cash flow. Whether do you have any questions till now? Rahul?
So depreciation is not relevant, but is also relevant.
Hmm. Depreciation is not relevant, but it is also relevant. Okay.
Because of the fact of tax.
Because of the fact of that.
Tax is not there, it is not relevant. If tax is there, then it is relevant.
Right. See, even if tax is not there, depreciation is actually relevant. Because then also you will add back depreciation. Say the tax is 0%, you will add back depreciation, right?
creative, but in any case, the cash flow will not change the books.
Yes.
The tax and depreciation is only one.
Yes. So this is because there is a tax shield on depreciation,
Depreciation on its own is
which
not a-
means because of depreciation, your actual cash flow of tax is getting impacted. So depreciation is actually not relevant. You don't have to consider, but taxation is relevant. But because of depreciation, your taxation is also getting impacted. So depreciation is indirectly impacting your tax. Yes, so it is indirectly it is affecting. So depreciation is a villain of any capital budgeting. You know, I'm telling you, most students do mistake ignoring depreciation impact when making capital budgeting problems. Whenever they are solving any problem, whenever you see depreciation, okay, you have to remember phase of Thofik. You have to remember that yes, one time Thofik said that depreciation is relevant when taxation impact is there. Why? Because depreciation changes your tax outflow. So which means there is a tax shield on depreciation. There are two ways of calculating. One is you reduce depreciation, you calculate the profit before tax. There are two profit before tax. You reduce taxation and then you again add back depreciation. Another way is just that you just have to take this 1 lakh rupees directly. Okay, don't, because depreciation is not relevant. Don't deduct depreciation. Okay, I'm just going, if I'm using a finance mind. First, what we did, first we found out the accounting profit, that we converted an accounting profit into cash flow. Now what I'm doing, I'm directly like doing the finance calculation. Okay, this is the cash inflow of 1 lakh rupees minus taxation. Taxation is actual outflow or not? It is actual outflow. Say the taxation rate is 50%. You will just deduct 50%, 50 minus K. Now you will add back the, why we are adding? We are adding tax shield on depreciation. I'm telling you why tax shield on depreciation, which means because you are taking depreciation, actually you are paying less tax, right? Suppose there is no depreciation, you will actually pay more tax. Suppose you don't have any depreciation, you will pay 50,000. But because of depreciation, you are paying only 35,000. So this difference of 15,000 is,
Depreciation and tax.
yeah. I think some marriage is going on, huh? Or maybe Pujay. Fine. So ignoring all the distractions, you have to. So whenever a taxation, okay, we just pause for a second. Yeah. Okay, but I think it's been 1 hour. Yes, it's been 1 hour. Yes. We'll just complete it. So whenever any depreciation comes, you also have to consider tax shield on depreciation. So there are two ways of calculating. First is, this is the easy way of calculating. Okay, have the PAT, then add back the depreciation. Straightforward, you get the cash flow. Second one is you add the cash, deduct the complete on taxes, and then you add back the tax shield on depreciation. So what is depreciation? 30,000, 30,000, which will become 15,000. So now what is the net here? 50, negative 50,000 plus 15 is equal to 65,000. In both the cases, the answer is same, but only the approach is different. Okay, you understand both these approaches? Any approach you can follow. Okay, in textbook, tax rate or depreciation approaches follow, but you can also use this approach, whichever you feel comfortable. Okay. And in many places, many students don't understand the concept of tax rate or depreciation. Why? Because they don't understand the concept of incremental cash flow. When you open your module of financial management, you don't find any word called relevant cash flow, incremental cash flow. This is just another topic that I've included so that you can understand the tax rate and depreciation. Because only the cash flow which is relevant, we have to consider for decision. Irrelevant cash flows, all we have to We don't have to consider for decision making. Understood? Comfortable? Fine. Now, starting from zero, you are the CFO of the company. CEO comes to you. He will tell you, Thofik, I have one project A. Whether I should accept or reject, what do you do?
Ask for data.
Ask for data. Class is getting heavier. Don't worry, it will get complicated. Okay. So what you'll ask for data? What data you'll ask?
Cash.
Cash flow. Okay. Then all cash flows you will have? No. Only incremental cash flow you'll ask.
Depreciation.
Then you should also see the depreciation impact. Then
Tax.
taxation. Okay. Whatever I'm teaching you as a concept is actually an adjustment in the actual problems which you're going to solve. So depreciation is one adjustment, taxation is one adjustment. This relevant, irrelevant, incremental category is one adjustment. All these are one adjustment in problems. So when we solve problems, we get comfortable and problems will become cakewalk because we're understanding the concept. So right now you're investing some time for concept building, but once you understood all the concepts, once you understood how to make a decision, problems will be a cakewalk for you. So trust the process. See this. Okay. Now the next one. Fifth one. You have to ask what are the side effects. Okay. So side effects. Okay, I'll give you one example. There is Dr. A. Okay, wow. There is Dr. B. Okay. Now say Dr. A charges 15,000 for one operation. Dr. B charges 30,000 for one operation. Which doctor is good? Which doctor you will choose? You will choose Dr. A. You can say this cheaper. I'm giving one more information. Like okay, say there is an eye doctor. But once you get treatment from Dr. A, for eyes, your ear will also get. There is one side effect that happens that you will not be able to hear also. Then again you have to make one operation for ear that costs 25,000. So there is some side effects which Dr. A. No, which doctor is better? Dr. A or D? B. Why? Because there is no side effects. Correct. So which means for considering any decision, you have to see whether there is any side effects or not. Okay. Now this was a comical example. Let's get into a real business life example. Say Shankar Academy. Okay. Now you are actually planning to open one more branch. One more branch of Shankar Academy, say in Purushottam. Okay. This is here in Alwapet, you are opening one in Purushottam. Okay. So here inter classes are happening and inter classes are happening, final classes are happening. There you want to open one for foundation. Okay. Now you will budget. What you will budget first? You will budget the number of students, you will budget everything. Say 1 lakh students, or say 1 lakh is very high here. So say 500 students. Your budget in Shankar Academy for Purushottam. Good. Good. Imagine, you can imagine, okay, 500 students. One day that can be a reality, but right now we are just making some imaginations, okay. 500 are coming, but actually you're paying more salary to faculties, and actually there is a negative cash flow. There is a negative cash flow from there. Say the negative cash flow is 1 lakh rupees. Now, whether you will consider opening the branch or not, you will not consider. Why?
Negative.
Because it is negative cash flow. But if you see the side effect, I'm telling you, because of taking that classes, 70% of students passed in CPT. And you can actually directly get that 70% of students to inter and final classes here. And here you will earn revenue per student 45,000 rupees for inter classes. And per student some 50,000 rupees for final classes. Now, that decision is relevant or not relevant? It is relevant. Now you will open branch or not?
Negative. You have to check.
You will have to check. What you have to check? The total cash flow of 75 of that 70% student. Then you will come here, you will deduct the here expenses, and then whether you will see here do you have any incremental cash flow or not? And whether you are having any incremental cash flow here, you will open the branch. Now what is this? Side effects. Okay. Because of making one decision, you have to check whether this decision impacts cash flow other way or not. If that cash flow is is impacting in other projects, then that cash flows also become relevant for making that decision. Okay. So you have two projects. You're not touching any project. Okay. I'm just giving you one more example. You have one magazine. You're opening another magazine. Now, because of that magazine, this magazine sales also reduces. Right? Because of the concentration of one, because nobody will purchase the magazines. Right? So that decision you should also consider this. So this can also be one adjustment in one. So whenever you ask for cash flow, you ask one more question to the CEO, whether because of this project there is an impact on our other projects or not. If there is an impact on other project, you have to evaluate those other projects also, and then you have to see the incremental cash flow, and that cash flow you have to consider for this decision. Understanding the bottom line. Slowly we are actually diving into the topic. Once we take out the problem, all these concepts we remember. Now the last one, okay. I know the class is getting heavy, but this is the last one. Right? It is working capital adjustment. As I said, whenever you're having a balance sheet, you're having a set land, building, machinery, okay, say 1,000 crore rupees. You're taking a debt of 1,000 crore rupees. Okay, you purchase land, you purchase building, you purchase machinery. You're seeing all the land, building, and machinery. You earn profit. You purchase the land, purchase machinery, purchase building. You're just keeping it and you're seeing it. Ah, I have land, I have machinery, I have building. Whether you earn cash flow, you earn profit. No, fine. You earn cash flow, you use that asset. And for usage, you also need some money. Right? What is that money for? Yeah, working capital. Say your working capital requirement is 100 crore rupees. Now, how to find out this working capital requirement? You will learn in another chapter of working capital management. Okay. But for now, say you have this working capital, you also require working capital for 100 crore rupees, because in business, first you have to make an expense and then only you will earn income, right? So you'll have to invest for salary, you'll have some creditor, supplier period days, and all this. For that, for running the business, for day-to-day activities, you need 100 crore rupees. Now, I will consider the cash flow of working capital only, right? In year zero, you are investing 100 crore for working capital. Working capital, we all know. At the end of year one, you will receive that 100 crore rupees. Now you receive this 100 crore rupees, you'll take it home. Huh? No, what you will do? You will reinvest this, right? So you will reinvest 100 crore rupees. Again, year two, you will get back your 100 crore rupees again. What you will do? Again, you will reinvest. Okay, say the project in the third year. Now in the third year, you will again receive this 100 crore. What you will do? Now you can take back. So which means whenever you have working capital, now again, this is also an important thing. Many students make one mistake. Whenever there is working capital in the problem, they deduct in year zero, because this is very usual that you have to invest in working capital, but they forget to add back in the end of the life. So whenever you have any working capital, you have to deduct that working capital in year zero, and you have to add back that working capital in the end of the year. What is the concept? Because working capital is reinvested until the project ends, until the business ends. Because working capital is used for business till the time the business is getting up. Last time, you are the CEO of the company. The CEO comes to you. It lasts Thofik, I have some project. Whether to accept or reject, what you do. You will ask data. What is the data that you ask? Cash flow. All cash flow you ask. Huh? Only incremental cash flow you ask. Then what you will ask? You will ask the taxation impact. Then what you will do? You will check. You will add back depreciation. You will see the tax and depreciation. Then what you will do? You will do the working capital adjustment. Then you will ask one question: whether this cash flow will have impact on other projects or not. Side effects. You'll ask what is the side effects. After taking all the relevant data, what do? You will tell, okay, I'll come back tomorrow. Okay. Then you will do all the calculations. Tomorrow we'll do all the calculations. And then we will give them and take decision. What are the decisions that you have to take? Accept, reject. Accept, reject. Then mutually exclusive decisions. Then capital relational decisions. Correct? Huh? So you have to take all the data. You have to go back home. You have to revise all this. Tomorrow we will again come back to class. We will do the calculations and we will answer the CEO of the company whether to accept, reject, or whether we have to take any mutually exclusive decision or the capital relational decisions. Correct? Huh? So theory class always seems heavy because we are not doing any problems. And when we do any problems, we feel very light. Why? Because we understood all the concepts, we just have to apply these concepts. So whenever we do any numerical problems, I will also be writing, you will also be writing. So the class will be very light and the class will be very chill. But whenever we do any theory classes, because you have to focus on the theory subjects. I mean, you have to focus on the theoretical concepts because that is what will help you. Any subject, theory is like an investment. Okay? You will not get any immediate pleasure. But I'm very sure that you will get the pleasure doing this. So with this, we'll end today's class and we'll discuss the problems tomorrow. So tomorrow, straight away, we'll start from problems. After, again, histories. So thank you very much. See you in the next class.